See, one of the inefficiencies noticeable with regard to making investments in the debt category of mutual funds is the level of expenses charged in these schemes. Clearly, the investors lose value by virtue of the expenses charged, which again is much higher if it is investment in the non-direct category, which is I think called the regular category, and in the direct category it is on a slightly lower side. But nevertheless, when one goes through the various debt fund schemes of the different fund houses, there is a huge discrepancy and differences across the fund houses with regard to charge of expenses. While I do recognize and notice that funds which require investments into corporate bonds of a longer duration, etc., would take more effort on the part of the mutual fund team to make enough analysis of the credit risk, etc., compared to investment in easier options like treasury bills and all that, which doesn't really require a great deal of study and evaluation. The funds do make a difference in terms of the level of expenses, but I would tend to think that even on in cases where whether it is a credit risk fund or corporate bond fund or funds of a longer duration like dynamic bond fund, the level of expenses charged over years should ideally be coming down, because the mutual funds have picked up more ability to manage this, and now artificial intelligence is available, which minimizes the level of human efforts. But one doesn't really see whether this is got translated into benefit to the investors. So one of the critical aspects to look at any point in time investing through mutual fund is the amount of expenses charged. And there is no permanency to the amount of expenses, because when I invest, I may notice it to be low, but 6 months down the road, they can increase the amount, within the permissible limit allowed under the SEBI rules. So this is a very vexed issue, and it really requires a lot of effort on the part of investors to constantly monitor. And if they really notice the sharp increase in expenses, and if they exit the scheme, then they will end up paying tax. So to some extent, the investors are locked in into a particular scheme, given that entry and exit on a random basis is not very tax efficient. So there are various aspects at play, and my fear is that the change in law, which might logically compel existing investors to be locked into these existing investments, at least for a period of 3 years, to get the benefit of long-term capital gains. And even if they continue beyond 3 years, they will be entitled to the benefit even for eternity. Somebody holds it for next 50 years, technically they are entitled to the present position in law, unless the law itself is changed subsequently. So given all these factors, I think there has to be sufficient vigilance to ensure that the mutual funds do not abuse the position and increase the expense rates to these existing schemes. One of the fear that I have is fresh flow into these schemes will now stop. I doubt whether people will invest in large quantum into the existing schemes after 1st April. So there will be stagnation in AUM, and the AUM only start coming down as people redeem whenever they need money. So there will be a temptation for the mutual funds to continue to maintain the old level of expenditure, which as a percentage of the AUM will start going up. So the people who are continuing to remain in these funds may suffer a lot more in the longer run as they hold the investments over a longer duration. So I see many variables, many potential issues. So I think it is important for various agencies, including the regulator, to really look at this very closely and make sure that the investors don't lose in the process. I've taken a longer time to explain this. I hope I have come across clearly about
Absolutely, sir. In fact, registered investment advisors, RIAs, who are fee-based, they should actively monitor and then highlight it. And if need be, go with their forum, ARIA, and others too, the regulator, if expense ratios are being misused.